In this QDVO ETF review, let's take an in-depth look at this covered call fund. Its returns have been impressive relative to even funds like QQQ. QDVO is a growth fund with above-average distribution yield. The yield alone stands at a whopping 9.4% thanks to its covered call strategy. What's more, QDVO has done better relative to some other covered call funds like JEPQ. Let's understand why. The first thing about QDVO is that it asks for a slightly higher fee of 0.55%. JEPQ, for instance, comes with a 0.35% expense ratio. While it matters how expensive a given fund is, as long as it generates above average returns, it may not matter. QDVO is an active fund, meaning there are fund managers who sit and pick stocks for the fund's underlying portfolio. The fund focuses on the large cap segment of the US stock market with growth and relative performance in mind. Besides that, QDVO states that it pays attention to the management track record. It probably means management ability and consistency to drive profits and stock returns. But let's look here. QDVO says that they focus on relative performance too. This is likely the same as momentum factor investing, which is a bit fuzzier concept. Momentum investing entails buying stocks that showed better performance relative to peers. For example, first they look at the 12-month price appreciation and then rank stocks based on that. And a typical standard momentum strategy would buy stocks that land at the top of the list. They may also short stocks that land at the bottom of the list. As for QDVO, we don't know exactly what they're doing. They probably start with some sort of universe of large cap growth stocks, and then they narrow them for the stock picks based on probably some growth and momentum relative performance characteristics. But we don't know for sure. And my guess it's momentum that drives the stock selection, because I saw that some of the other funds by Amplify use momentum for their strategies. And that's the main drawback of active funds like QDVO. We don't really know what they're doing. Are they using some sort of consistent rules for stock selection? Or is there a discretionary component, meaning there are humans who make decisions on investments based on some qualitative research? Then how consistent QDVO applies these rules? To what degree the fund depends on a few star managers to drive its performance? We don't really know any of that, and that's a risk with active funds. Many investors compare QDVO to some other growth funds like, let's say, QQQ, that tracks Nasdaq 100. But the thing is that QDVO does not limit itself only to Nasdaq 100 or Nasdaq traded stocks. They have many equities listed on the New York Stock Exchange too, like Home Depot and Procter & Gamble. On a typical day, QDVO invests in 20 to 40 stocks. For this reason, its top 10 concentration can be extreme even by Nasdaq 100 standards. The fund's top 10 allocation is at 65%. In comparison, QQQ's top concentration is 53%. And that's the problem with concentrated portfolios like this. They amplify both gains and losses. QDVO has done exceptionally well for itself, but that's a major risk to keep in mind. If we look at sector allocations, QDVO is heavily tilted towards tech at about 50%. That's a bit lower compared to JEPQ or QQQ. Sectors like consumer cyclical and communication are dominated by Alphabet, Meta, and Amazon. For this reason, adding QDVO to a growth-focused portfolio can create a lot of overlap. Now, as for covered call overlay, QDVO sells call options on individual stocks in a very active manner. They may also sell sometimes call options on broad market indices. If we look at their holdings, these are some of the written call options on stocks in their portfolio. We see that current written options cover about 40% of their underlying exposure. This percentage is not fixed and varies from 30 to 50% of their entire portfolio. Why is this important? Because covered calls cap the upside of a fund, and that's their main drawback. In return, QDVO allows investors to withdraw income on a monthly regular basis. However, here's the beauty of QDVO. They sell call options only on some portion, not the entire portfolio, and this allows them to capture more upside from their stocks. And that's where the main drawback of older generation of covered call funds like JEPQ or JEPY comes into play. I reviewed JEPQ in my other video linked here. JEPQ also writes cover calls, but it does so in a somewhat less flexible manner. On top of it, JEPQ cover call positions likely cover more of its portfolio. I say likely because cover calls in JEPQ sit in so-called equity-linked notes. ELNs are less transparent and look like black boxes from outside. Anyhow, all this means that JEPQ's price recovery from down episodes is somewhat slower relative to peers. For instance, JEPQ's stock price only now recovered from that April tariff plunge. Conversely, QDVO's price has fully recovered since then. Faster price recovery is key for cover call funds. Otherwise, the net asset value or NAV erosion takes hold. And net asset value per share is approximately equal to a fund's stock price. So NAV erosion means declining stock price of a fund. And that can turn into a nightmare for income-seeking investors that invest in cover call funds, because as NAV erosion takes hold, distributions will stagnate or worse, they may decline. It doesn't seem like NAV erosion is an issue for JEPQ, but its slower recovery in price relative to its other peers like QDVO is an issue and something to keep in mind. Let's come back to QDVO distributions. Because the fund invests primarily in growth stocks, its true actual yield from the company's cash flows is very low, under 1%, probably close to 0.5% most of the time. And so that means that the majority of the yield that we see, which is currently above 9%, comes from those cover call premiums. If we look at yield on cost, it is roughly up by 20% in a year. The largest factor behind it is a massive rally for large cap growth stocks. QDVO's distributions do show growth too. But this growth will largely depend on volatility and the QDVO's underlying portfolio performance. If volatility drops or the stock prices in QDVO's portfolio drop, so will its distributions. If we take traditional dividend ETFs, their distributions come from companies' cash flows. Conversely, cover call funds monetize volatility and cap their upside in exchange for regular income, and price appreciation plays a big role here too. The fund's net asset value per share must grow in order for distributions to grow, and again, that price appreciation of growth stocks play a big role here. And this is so because the bulk of QDVO's premiums get distributed each month anyway. Overall, QDVO takes a nuanced approach to cover call strategy, and that is something to like. Next, let's compare total returns of QDVO to other funds, say to JEPQ and QQQ. Since inception, QDVO has done very well. There are several factors behind it. First, large cap growth stocks are on fire. Second, momentum investing is doing well too in 2024 and 25. QDVO likely uses momentum to pick stocks. Strong momentum performance has been an important tailwind for the fund. QDVO did well on a volatility-adjusted basis too. The fund experienced a lower drawdown in the recent down episode. All this points in the direction of a bit more defensive nature of QDVO's portfolio. Its cover call premiums help it shield a little bit from downturns. Yes, a little bit. QDVO will still go down in sell-off markets, and its exposure to high growth, high beta, high risk stocks make future drawdowns inevitable. Next, let's see how QDVO and JEPQ capture the upside from QQQ or Nasdaq 100. And here the comparison will not be perfect. QDVO, after all, does not track Nasdaq 100, while JEPQ more or less does. So keep that in mind. Anyway, we still see that both JEPQ and QDVO capture less downside of QQQ. The downside capture has been so far comparable for both funds. But when it comes to capturing upside, QDVO shines. Because the US stock market tends to trend up, capturing more upside is very crucial. And JEPQ's lower capture of upside is a big problem. And I think many income investors are taking notice of that, and they started transitioning their money away from JEPY and JEPQ. So to summarize, QDVO is an active fund with a focus on large cap growth stocks. It also picks equities based on momentum or relative performance factor. To invest in QDVO is to have faith in its management to execute on its active investment strategy. And I have a feeling that probably QDVO has some sort of rules that it follows for security selection. And of course, that's my guess. But if that guess is correct, that's probably better than some other active funds. For instance, take active ETFs like ARKK by Cathie Woods. They use stock picks that manage to ruin their multi-year stellar performance. At the same time, QDVO comes with a top-heavy concentration and a tilt towards tech. And tech stocks have been rallying non-stop almost for the last couple of years. And QDVO will benefit from that. And of course, if they tank, the converse is true. I also like how QDVO takes a very nuanced and flexible approach to cover call strategy. And this ensures that its stock price as well as distributions will continue growing in a growing markets. And that's all for this video. I hope you found it helpful. How do you use QDVO in your portfolio? Let me know in the comments below. If you're interested in my comparison of JEPQ to GPIQ and QQQ, take a look at my analysis here. Also like and subscribe for future insights on investing. All the best!